You actually had a surprisingly big revenue beat in the second quarter, and yet you said that this momentum could wane going into the second half of the year. Why?
Yeah, we did. We had a good quarter relative to what we expected. Our adjusted EBIT was of 1.1 billion, and revenue, as you said, was a beat. What we see happening for us at Ford, the chip crisis was a disproportionate issue for us in the second quarter. One of our key suppliers in Japan had a fire at their fabrication facility, and that shut down production in the quarter. And 70% of the volume that we lost, more than 70% of the volume that we lost in the quarter was due to that. They're up and running, so we will have those chips flowing to us starting this quarter. All in all, though, we're seeing a 30% sequential improvement in volumes through the third quarter into the fourth quarter. But again, this situation is opaque. We're managing it week to week, day to day. And, it's something that we're going to have to deal with through the rest of the year and potentially into 2022.
Of course, John, there are the things that are a little hard to come by these days that when you start building EVs, requires an enormous amount of copper, right? Nickel. How about all of the components that go into making batteries? Is it possible to even forecast the supply of these when you know that demand is so high and it's hard to get a sense of supply right now?
Well, that's the thing, a silver lining coming out of the chip crisis for us. We're a new company. We're spending a lot of time benchmarking others. We're talking to all our big tech partners, leaning into how they manage, complex, high-tech supply chains. And we're applying those learnings to what we're going to do with batteries. We need to get deeper into the supply chain. We've got to get to the source. We'll have to do strategic buys. We'll have to make sure that we have multiple sources for certain commodities that are going to be critical to us. So we're learning a lot from the chip crisis. We're going to apply that to our purchasing process, much more strategic. Our industry has typically been focused on just-in-time supply. We're shifting, more strategic, focusing on how we manage the risk as we work through the supply chain. And then for batteries, which are going to be a key component for us going forward, we're going to manage that, and we're going to be deeply involved in that from a strategic standpoint.
John, when will the chip shortage not be an issue for you anymore?
Well, that's hard to say. I mean, we've talked to all the fab manufacturers. We're having meetings. We're going deep into the supply chain to understand what's happening there. I'll have to tell you that they're telling us they're increasing capacity, and that's important. But no one can really call when this is going to ease. We see it going through the second half of the year, potentially into 2022, and we'll manage it as best we can. And we've been doing that so far. For us, one of the things that helped us drive that top line revenue is incredible demand for our products. So you've got the shortage of supply. We have incredible demand for our new products. It's just allowing us to manage it the best we can, but it's also providing us that opportunity on the top line, stronger mix management, to try to, get everything that we can out of the situation.
That's a very diplomatic way of saying you could raise prices and people will still come flooding because demand is that great. And certainly we have seen prices increase dramatically with supplies so tight, particularly on car lots. I'm wondering, though, as some of the supply chain issues start to ease up, how can you keep prices this high and keep them going up?
Well, we have strong demand for our products, but we've said, and we've been consistent in this, as supply and demand become more in balance, you will see some price reductions, and you will see the pricing moderate over time. But again, our product, it's the strongest product lineup I've seen in the 30 years that I've been at Ford, and that's going to continue to give us those tailwinds on top line. And we see that happening through the rest of this year, and actually strengthening next year, because we're going to be launching the new Bronco now. We're going to be launching the Maverick. And then next year, we have the F-150 Lightning coming. So we have a lot of product coming next year as well that's going to help us and keep those tailwinds coming.
John, realizing this may not be your focus when you wake up in the morning, I wonder if I could ask you about used cars, the incredible demand that we've seen and the lack of supply. What are you hearing from dealers around the country? Does this get worse before it gets better?
So exactly, we're seeing a lot of tailwind from used car prices. That was part of what helped us in the second quarter here. What we're seeing is used car prices are starting to come off a little bit, not a lot, a little bit, but we do expect them to stay high through the rest of this year into next year until that supply and demand equalizes.
I know we were seeing a lot of demand based on COVID. A lot of people stopped taking public transportation. They wanted to have the safety of their own vehicle, and that really seemed to get the sales of used cars moving quite a bit in the last year. With what we're seeing with the Delta variant and new mandates, in some cases, potential new policies for people in their workspace, do you expect that to kick up again as we head into fall?
Well, we're continuing to see strong demand. You saw strong demand in used cars. You're seeing strong demand in new cars. I think people are making their own decisions, deciding what is a safe form of transportation for them. And I think that's added some of the tailwinds to the industry, both for new and used.
John, you said that actually it's important to keep inventories lean, akin to what we saw during the pandemic, which is a shift when previously a lot of car companies and frankly other manufacturers wanted to have big inventories to meet any increase in demand. Why is this the right way to go forward? A lean inventory model where you really look at the orders first?
Yeah. Well, we're on a new path forward. We're looking at the entire business model and trying to sort out what is the best path forward for our customers. One of the things we're learning through the shortage of supply due to the chips is that we can really give a better experience to our customers if they're actually configuring and ordering the vehicle online, then coming to their dealer, having delivery of that vehicle. And what we're finding is that's good for not only the dealers, it's good for the customer, and it's good for us as a business. So we're very focused on keeping that day supply down. Typically, we ran 70 to 75 days. We see 50 to 60 days being more of a sweet spot, and we think it's going to benefit everybody that's involved.
All right. Well, in our Around the World in 6 minutes, I want to just get your sense, lastly, to conclude with the labor market and the fact that with such demand and the fact that you do need to potentially restaff and rehire and restock, how hard has it been? How much have you had to offer in additional salary and additional benefits to attract the labor that you need?
Well, we've been running up since middle of last year. We've been running our plants safely due to the COVID crisis, and we have great partners in the UAW. We're not having any staffing issues at our plants. We're not having staffing issues in our operations elsewhere around the world. So we've been managing this. We've been proactive. We've been out in front of it, and we're not seeing any issues from a staffing standpoint anywhere in our operations.